Hi everyone, welcome to ECO730. Now we are going to do the demonstration of how to estimate a GARCH model, a standard GARCH, and then the T-GARCH, which is the threshold generalized autoregressive conditional heteroscedasticity, as well as the EGAC, which is the exponential generalized autoregressive conditional heteroscedasticity. So I'm going to use the same work file that I've used under the ARC chapter. So of course I'm going to look at the exchange rate between the Namibian dollar and the US dollar, and I just decided to name that USD. All right. So of course, in under ARC, we have already tested that yes, there is a presence of the ARC effect, and so therefore the ARC model would then be the appropriate technique to use to estimate these type of data. All right, and not the OLS. Okay, so now how do we estimate the standard GARCH? The standard GARCH can be estimated in the following manner. So first of all, okay, so we are going to start by estimating our equation. So we click on quick estimate equation, then we type in USD constant USD lagged by 1 period. Okay, then of course we have to change our methods of estimation here to arc. So we click here method, we change it to arc. Okay, now you can basically see that this is how our box looks like. So if we have to estimate the general GARCH or the so-called standard GARCH, so that means that we have to specify that we need the arc term as well as the GARCH term. You remember from the theory, we need the GARCH term and the arc term. So these are your P and Q. Okay, so and then since it's just a standard GARCH model, we don't have to specify any threshold, so it's basically 0. So if we click on OK, then this is how the output will look like. Let me just enlarge that. So this is how the output will look like. So then this is basically what you have to look at. Okay. So if you, this is your, so remember there where we have alpha plus beta. So this is your alpha, this is your beta. Okay. So therefore, this is your arc term, this is your GARCH term. So if you add them, it will give you 0.61. Okay, so that 0.61, is it closer to 1? It is quite high enough, you know, and so therefore we can actually then argue that yes, volatility is somewhat to a certain extent persistent. So that is basically how we estimate the GARCH model. So, and then just like in the previous case, you will have, this is your mean equation, this is your variance equation. Now, how do we then, so in other words, so basically what you have here is now, this is the short-term volatility, and this is the long-term volatility. And then when you combine them, so the moment they are closer to 1 or equal to 1, they actually indicate the persistence of the volatility. And that is how you interpret the model. Now, how do I then estimate the threshold GARCH? So we simply, instead of going to quick estimate equation and so forth, just click here on estimate. And then so now you can see you still specify arc to be 1, GARCH to be 1. Now we have to change the threshold to 1. And you can basically see here that you have GARCH or T arc. Okay, so now we don't have to change anything else. All we have to do is just click on OK. And you see now this is our output. Now pay careful attention. Now the first thing that we need to identify here is the coefficient of the estimates different from 0? Remember from the theory, if this coefficient, this is the coefficient of interest. Okay, remember from that equation where we said we look at the, where we have that gamma mu t minus 1 squared, and then we are saying that gamma must be, it takes a value of 1 which is less than 0, and it takes 0 when you know the conditions from the theoretical part. So the fact that this coefficient is different from 0 actually gives us an indication that there is indeed a symmetric effect. That is the first thing. So, and that's how you should start, even in explaining, when you are explaining this or interpreting this type of model. All right. Then secondly, so this coefficient is basically going to be, if we is basically going to be 0.607 or 0.61, just to, if we round it off to 2 decimals. The second point is that the fact that this coefficient is greater than 0, it then gives us an indication that in this case, the negative shocks will have more impact than the positive shocks. Okay, in other words, the negative news will increase volatility in the future. Okay, and obviously, again, if we check, this coefficient is actually, luckily enough, it's actually even statistical significant, meaning is statistically significant different from 0. Okay, so again, this is another indication that the data contain a threshold effect. So if we have to interpret this in terms of what we have here, in terms of the Namibian dollar vis-a-vis the US dollar, we are basically saying, of course, we know that we the negative impact is that obviously we definitely assuming that the Namibian dollar is depreciating, meaning that we are paying more Namibian dollar per US dollar. And so that would then imply that as we pay more of that, or as the US dollar continues to strengthen, it will then imply that the volatility in the next period is going to be higher compared to when the Namibian dollar is the one that is appreciating. In other words, when the US dollar is appreciating, the volatility is likely to increase in the next period compared to when when the US dollar is appreciating, the impact is going to be high compared to when the Namibian dollar is appreciating. Okay, so, and therefore it then basically indicates that the negative news, which is basically the depreciation of the Namibian dollar, is negative news, and it has larger effect or leverage effect on the volatility. Okay, so, and that's why we always say negative news does impose more volatility, or does result in more volatility compared to positive news. All right, then how do we estimate the EGAC? Now the EGAC, again, we simply just click here on estimate. Now you see here on the model that we have to change the model here. So we have to change the model from GARCH TARC to EGAC for exponential. Remember I said the exponential type of model is usually good for determining the spillover effect, especially in the stock market, where you have companies that are dual listed. If you have a company that is dual listed in two different stock markets, it's a spillover effect from that act of being dually listed, meaning from the relatively larger stock market to the relatively smaller stock market where the company is listed. All right, so once we change that, then all we have to do is just click on OK. Again, the coefficient of interest, if you go to the theoretical part, the slides there, we are interested in coefficient 5, okay, C5, where we are looking at resid -1, that is basically your active, and then the square root of a GAC lagged by 1 period. So, and that is basically C5. Now, what we are seeing here is that, yes, of course, the coefficient is different from 0, so meaning there is an threshold effect. But there is a contrary result here. Why? Because this coefficient now is less than 0. In other words, it's not greater than 0. And so because of that, so that coefficient is negative 0.198. Because of that, since it's less than 0, then we are basically saying, and we are also saying that it's statistically insignificant because 0.08 is greater than 0.05. So we are then basically saying that the negative shocks will have smaller effect on volatility than the positive shocks. So therefore, we are then basically saying, yes, there is leverage effect, but it's not that much. Okay, so we are just then basically saying, in this case, we are just basically saying, the Namibian dollar per US dollar, or in other words, you can basically say, if there is a weakening of the US dollar, meaning there is a strengthening of the Namibian dollar, then that result will then suggest that volatility is likely to be lower in the next period. Okay, because of that positive news. Because remember, we said investors usually don't react so much to positive news, they react to negative news. The moment they hear that there is going to be a crash, or whatever the case is, or there's a price change in the direction that is against their investment, then obviously they would want to pull out their or they will readjust their packaging of their financial instruments or investments. And so therefore, that's why if the domestic currency, for example, if the South African rand is appreciating, investors won't react that much because that is good news for them. Okay, good return on their investment. But the moment the rand starts to depreciate against the US dollar, say for example, then obviously you will see that impact within the model, and it will be reflected in the future forecast. Okay, so now in this case, the fact that it's negative, less than zero, and also statistical insignificant, it basically then says the positive shocks, which is basically the strengthening of the Namibian dollar, will not result in any future forecasts that are going to be more variable. Okay, and so there is going to be less volatility in the next period, and so therefore, in this case, for example, if we compare these results with the previous one, we can basically say the results of the EGAC definitely differ from the results of the TGAC, because the TGAC, we see that the negative shocks will have a larger impact in the next period, but in this case, the positive shocks will have a larger impact in the next period. And that is basically how you do, or how you deal with estimating TGAC and EGAC and the standard GAC models. That is basically it.